All right, good morning and welcome to the show. This is a weekly jargon. I am Jose Rodriguez.
Rohi Zachariah.
And today, Rohi, we have some local updates and we can talk a little bit about the market and housing. I think people always have that in the back of their mind, especially if you're looking to buy towards the end of the year or maybe at the beginning of the year. This would be a good time to start the prep. But before we start with that episode, let's go ahead and catch up on some local news. So I understood you weren't part of that Christmas tree video that went out, but nevertheless, we did have a Christmas tree parade, Christmas tree lane parade. We had our courthouse tree lit for the first time. I think it was 30 years, based on Supervisor Poitras. I haven't been here that long, but it looks like that was a big event because the lighting of that Christmas tree brought back a lot of nostalgic feeling of, hey, this is something that this town used to do, light up its Christmas tree. I understand it's one of the biggest Christmas trees. Not sure if you had an opportunity to attend, but your thoughts, what's going on, latest updates?
Yeah, I was there in the cold. It was, a good event, and it is a giant tree. I will say, I don't know if it's the biggest tree in Madera, but it is a giant tree. And it was good because it's very well attended. The community came out, lined up the streets, in anticipation of not only the tree lighting, but the parade that follows ensued, and obviously the events that they had at the park. And I would agree that the community, I mean, they want to come together, and I think that's evident in a lot of the parades that we've been a part of. That you'd think that you have a couple of parades, 2, 3, 4 times a year, people would kind of be burned out on them, and people like it. They like to come out. So
even with the extreme weather, right? Because it was cold.
It was freezing.
Right?
Oh, yeah.
And people still bring out their kids. I think the first time that I attended a Christmas parade, I must have been layered up, beanie, gloves, cold. And as I was circling through Yosemite and made our turn, I noticed the people. There was a ton of people. Mm-hmm. No different than our parade that we have for the old timers. But, people always ask, what can we do in Madera? Mm-hmm. And I think these two events are big events for residents because they enjoy bringing their kids that Christmas spirit, especially during the Christmas, during the holidays.
Yeah.
It really brings these families together, and they're willing to bear the weather to be out there, whether you're at Christmas at the park, you're at the parade, or in this case, you were at the lighting at the courthouse.
Yeah.
Which I thought was pretty cool. I didn't get an opportunity to stop by Christmas in the park, but I did stop by the lighting of the Christmas tree. My understanding is that between certain counties, it's one of the largest trees lit. Not necessarily the largest tree, but the Christmas tree that was lit. And again, we'll have to get some fact checks on that to make sure that we're not misquoting anything.
Yeah,
there.
we might be in competition because my dad's tree is probably almost as big as the city's tree. So.
But do you light it?
We do light it.
Oh, you do light it?
Oh, yeah. You
Okay.
can see it for miles. So.
Really?
Oh, yeah.
Okay, well, shoot. I didn't know that. So we'll have to check that and compare. But we'll dive into our topic today. For some of you that are in the market of purchasing a home, I mean, we talk about this constantly because, we want to give you as much information as possible to make an informed decision, right? What's taking place, market trends, and what have you. But today, the important event that's happening is that the feds will hold a meeting, or are holding a meeting that's live. But somewhere near 11 o'clock, they'll decide on where the Fed rate goes, right? Mm-hmm. And right now, it seems like it's pushing for a rate cut based on previous projections, data from certain reports, inflation, although they're conflicting because there are members of that board, the Federal Reserve Board, that don't feel that this would be the best time to do it. But you start seeing unemployment rate creep up, and you have a lot of pressures from the administration saying, hey, we need to get those rates down. Yeah. The question now is, what happens if you take that approach while inflation is starting to creep up?
Well, and I think that, like you've always told us, when you see a rate cut, it doesn't necessarily automatically translate, for instance, to like the housing rates, and because there's so many different rates of where people are lending money and borrowing money at. So I know I guess my limited understanding is if the rates cut happen, then it helps incentivize like corporate money, because then they'll want to take loans out and be more likely to spend the money, and again get that machine going again to kind of spur growth. But at the same time, the inflation part of, are we spurring too much growth? And I know there's conflicting information as far as, are we slowing down, or are we going faster? Are we too fast? Where we are at. But I mean, it's always difficult because, people that I know that have been on the fence for maybe 3-4 years, they haven't made that purchase on a house yet because they keep hearing, just wait, it's going to get better. It's going to get better. It's like they're all asking the same thing. When is the time? You know what I mean? Like, because nobody wants to miss out and be like, they buy and then 6 months from now rates get better or something comes along better. But it's hard to tell. Like, is it time? Is it, do we still wait it out? Like,
and that's a good question. I mean, if the way I look at it is, there's never really going to be a good time to buy. Rather, it's a need. Mm-hmm. Do I need a home at this situation that I'm in today? Am I renting? Is my rent close to what a mortgage payment would be? Then those are factors that you consider to take the steps to say, I'm ready to buy. And once you pencil out and do the comparison, you may be better off buying a home. Mm-hmm. And waiting for that opportunity may not come within the next year, may not come for the next 2-3 years. And a lot of folks that anticipated the crisis, well, they may have known, they may have done some moves, but see, not sure. It didn't happen to the majority of the public, not the majority of people. Had they known, they would have probably held back, right? Somebody was probably warning, but we didn't have purview to that, right? So I think if you look at when the peak of the housing crisis took place, it took place in 2008, but the trough at the lowest didn't take place till 2012. Yeah. So those that were waiting may have bought soon after, but prices continue to decrease up until 2012. So nobody knew that this 4-year span would be the opportunity, but there may be opportunities within that 4-year span. Now, if you have the ability to do it today, then essentially you can, because at the end of the day, even after you purchase that home, looking at inflation, looking at how prices have changed over the last 5 decades, you're likely to put yourself in a position where you'll have equity. Yeah. It just won't be at a rapid growth that you see in the last couple of years, but you will be there. And if anything happens similar to 2008, like any assets, they go down, but at the end, the trajectory is always to come back up. Yeah. So I would recommend that if you're in a position today and you have the ability, then do it. If you have the cash and you're waiting and you're not in a hurry, then wait. And let's see how this thing plays out. The one thing that is concerning to me, though, Rohi, is that we do have the commercial banking. That's where I think people that understand the economics of where things are, when these folks that had the commercial loans out, they got them at really cheap rates back when rates were very inexpensive. Now the maturity is coming due, and a lot of them will come due this year at the end of 2025 and at the end of 2026. Mm-hmm. So there is a concern of that amount of debt refinancing or jumping up for almost twice as much. Okay. Remember, there's a lot of different loans out there that people are going to wonder, well, shoot, how can I keep up with my current overhead once everything doubles up, especially the interest? And that's the concern there. So why the feds are playing this, they have to consider that if you don't do that, to allow these people to refinance into better terms, that could potentially be a problem for us.
Well, and again, I mean, waking up to, a couple of days ago, the article that I have here, housing market poised to crash worse than 2008, where it's going to plunge 50%. And again, this is the thing that you don't want to see, these kind of things, but these are the kind of topics where it's been tough over the last couple of years. When we talk with you and other people who keep saying, oh, housing prices, cost of building a house doesn't go down, houses can't crash. And I, when I always hear about the '08 crash, I was there, I was part of that, where my house went from 300 to 150, not overnight. It, like you say, it was a progression, but
you were knee deep.
But yeah, I was knee deep because I was part of that group that I wanted to refinance because I want to take advantage of, these great rates are happening. And come to find out, well, hey, if you're going to do that, you got to come up with that 150,000, and obviously that wasn't going to happen. So I was stuck for a very long time with those rates, And obviously, the tricky part of the article is it's talking about how in '08, a lot of the investment buyers was what kind of bailed it back out. You had these hedge funds and these giant corporations that came in and bought up a lot of that debt, or these houses that were in foreclosure, and they're speculating that this might not come around. And obviously, the end of the article talks about, you should buy gold and silver, which, transitioning to the next chart, when you look at silver over the last, 30 days, 60 days, has gone up dramatically. And I think to a lot of people's points, it was time. I mean, we keep hearing this word inflation, and gold and silver are supposed to somewhat mimic what the dollar is worth, but it's finally broken out, and it's, I guess, in scary territory. It's like, where does it go?
Yeah, and one of the things that I've known about silver and gold is that their ratio, right? What is the ratio silver to gold, right? 75-1, I think, was the last time I saw it, which is really undervalued.
Yeah.
But if it goes to what's historical trend has been, or average, anywhere between 30-40 to 1, then silver's undervalued.
Yeah.
And it's going to creep up. Look, I remember before 2018 or 19, we talked about silver, and I think at that time I was kind of scared of saying, I want to buy some silver.
Yeah.
But if you could imagine at $12 an ounce, I mean, at that time you would think, wow, it's not a lot of money. It's a lot of money to pay for silver. Yeah. Not knowing the impacts of what inflation can do to it, right?
Here's your numbers. 2018, it was at $16.
$16,
yes.
Yeah. And I think I bought some at 12, at 16, and but wow, at 40. I think this is historic because back in during the crisis, it reached like 40 some or to the 50 level. So just like gold has surpassed a historic, right?
Yeah.
And that should be I'm not saying it's a warning, it's an indicator of how our dollar has devalued, maybe, and how, well, if you want to preserve the value of that dollar at that given moment, then these assets represent that. Now, has it tanked? It does, but people go to safe assets, right? Tangible assets, and I think gold and silver, these precious metals, have always been something that people can rely on, because over thousands and thousands of years, this has been the metal that always survives, right? Gold and silver. Now, people may argue and say, well, no, it's just overvalued. Well, I mean, yes, but I mean, this is what makes people safe and say, I trust that I have a metal that can be utilized for many technologies, for many advanced tech.
Your batteries, your
and
solar
what have you, right?
And all that.
Now I can trade that and be able to sustain myself, right? If it came down to that doomsday prepping or something like that, right? But again, when I look at $60, it gives me an indicator of, wow, something needs to give here so that we can stabilize where we're at, right? Is this the same thing that's happening with homes? Are we overvalued in certain cases, right? But you see it through your shop, right? Yeah. People come and they want to sell, and they see, hey, this is what I want to sell, some gold or silver. What do you see? What are the trends there?
It's I guess it's good because you see a lot of the people that have bought still, I mean, at higher rates than we've been talking about historically, but maybe bought in the last maybe year or two, and even if you go back 2 years into 2023 at $28-30, so you've doubled your money in 2 years. I mean, I think that's we've talked about because people think it's going to come off of that 60, and it will, because you got to think if you've doubled your money, you want to have profit taking, so there's going to be some of those sellers, but at the end of the day, once you've sold, you get that FOMO mentality of fear of missing out, and then you're like, okay, well, creeped up another dollar, I need to buy back in, and that's what's going to continue that drive. So it's also on par, I think, where argument is, when we talk about inflation and, the government tells us, oh, it's been like 10%, 15%, and you go like, what are you smoking? Because I think everything has doubled in the last couple of years, and I think that's why being at $60 makes sense because, you know, if whatever I'm buying, my commodity has doubled in price to purchase it, whether it be my home, you know, my milk or whatever I'm buying, then it goes and coincides with silver should be doubling as well.
Yeah, yeah, and like I said, I think there was a report there stating how it's undervalued because typically it tracks gold
Yeah.
30 to 40 to 1 versus where it's at today, right? Gold has really just kind of ran away, but coming back to its fundamentals, it should be somewhere in there. And again, you never know. We may be seeing silver maybe hit the $100 mark, you know, at some point. And then you're really wanting to know, hey man, something's going on.
Exactly.
But I wanted to bring it back because now in housing, we'll see how different that is in housing. And the data that we're bringing up here, mainly for our metros, right, or our zip codes, right? This is Madera, and we have a 93637 that says that the average homes here are going for about $396,000, right? That's the value of an average home, right? Again, all this information is brought through by Redfin, Zillow, and the U.S. Census Bureau, right? They gather this information. So nothing's me generating this. Is through a Reventure app here that I purchased. But anyhow, long story short, 93637, about 396 at the 93638, 353. And then you have these other areas that are over in the newest development, the Ranchos, 12 and 41, which is Riverstone, Tesoro Viejo, 523. Big increase, obviously there. But again, what makes that increase so high, right? So when we look at the overvalue, is there such a thing that's overvalued? Well, when I look at the charts here, again, they're computing this on certain fundamentals like income, household income, versus what is the value to income ratio, right? How many times, how many of your household median income reaches the amount of the current value? Is it 2 times? Is it 3 times? Is it 4 times, 5 times, right? So this is how they come with these percentages. They look at those fundamentals and they determine that the 93637, again, don't quote me on this. I'm just showing you what's on there, again, with data points, right? And part of it shows that 93637 is about 22% overvalue, meaning that a fair home value should be somewhere between 324 maybe to 330, right? What we see in the 93638 is, I mean, there's almost $100,000, 36% overvalued. And last but not least, when you come out here, you see very little, 8.5. Well, what drives that? What is it that makes that value, I mean, that it's not as overvalued as these other areas, right? So when I look at the income, well, let's look at the value to income, right? This is telling me that the median household income is about $78,000. So it's about, to afford the 396, it's about 5 times that household median income to get there. Back in 1970, that used to be between 1 and 2. So obviously inflation has really ran away and wages haven't kept up with that. So there's something going on. And again, a household median income, Rohi, only means that on average, right? Or the median, where is the concentration of those households here, right? There may be some outliers on that extreme income and then some really low incomes, right? But the concentration of that median means the middle. Where are we at? Not an average, but the middle. And that's kind of where you're looking at, 78,000, right? And that's grown in the last 5 years. Here you see an average of 63,000. I mean, I would beg to differ there because I've seen other incomes, right? But when you look over at this area, it's 130. Double the amount here. So if it's telling you that it's 4 times, then that's more, I think, sustainable than it is to be 5.5 times more of your median income. It's harder for these folks that make this amount of money, or on average, compared to these folks that make 130,000. And that's kind of where you see the overvalue. That's the fundamentals that they use. Again, utilizing these data points, they're going to tell you that this is where it's at. Now, there's other metros. We can look at Fresno, we can look at Clovis, and we can look at other parts of the U.S. And you'll see how these compare and what's taking place in their markets. Are we overvalued? I mean, I'm not scaring people, but I'm telling you that if these are the incomes, then it's harder for certain folks to catch up. Now, you may have those outliers, like I said, really good jobs. You buy a house here. For you, it's very inexpensive because you're making over $200,000 in your household. That a $4,000 payment for a mortgage isn't a big deal. But for those making anywhere between 70 to 80 to 90,000, it may be, and that's something to consider. So I wanted to bring this up because I think it's important to see, right? And when you're looking at the investors, again, we talked about the median household income. I mean, we already know what that is. It's 78,000, right? But anyhow, just thought and here's the interesting thing. I don't know where they get this, Rohi. I don't know where they get this data point. But when I looked it up, I think it's the U.S. Census Bureau. I don't know how good of a data point this is. This would be a fact check that I would do. But the college degree rate. This is saying college degree rate, population with bachelor's or higher, is about 3452 on average of a population that's 25 and older for 25,909, and it says about 13% on the 93637, right? So out of 25,000, about 3,500, right? You come out here, you see a 7.9%, right? Out of 29,000, only 2,300. But when you come out here, Rohi, you see a lot bigger percentage, right? Yes, there's less population, but the majority or a good portion, more than a third of that population has a college degree. So data doesn't lie, right? More income, more education, typically higher value, at least in these metros that we're looking at, right? So that's something to consider. Again, I think the focus of our show today was to talk about, is housing affordable, right? And we're giving you some metrics to be able to make good decisions. Yeah. But I think it does. You have to ask yourself those questions if you're looking to buy in these particular metros, right? And if you need more information on that, feel free to call us. We'd be more than happy to assist you, especially in the mortgage industry. If you're looking to buy a home and you don't know if it's the right time, come talk to us. We won't just give you the sales pitch. You should buy. We'll tell you why and where and how is it financially suitable for you, right? We're not just the finance advisors, because we don't have a technical license that says that. We're telling you based on experience in my profession, what I do in the mortgage industry. What do you see, Rohi?
I think the one thing that bothered me coming out of the last crash was, especially when we had like the too big to fail, this like, banking philosophy of we got to change, who we're lending to so we don't do this again. And you had this warm, fuzzy feeling thinking like, oh, good, they're double checking everybody that they're giving money to. They're verifying their incomes, because I know a lot of people were using different games to inflate their incomes or, make it look like they were, able to make these purchases. But I feel like coming back around, I feel like it's the same thing where we're again saying, hey, look at the chart. We already know these people can't make these purchases, but they still are somehow, and it's not that I want to be in a position of like restricting who can buy a home, but the data kind of proves it. Like, look, if you're not even making, it's 5 times your income and that doesn't really make sense, how are we getting these through? How are we still approving people to get into these positions? And is it on the crazy side? Is it intended to be that way? Is it intended to prop people up so that they do fail? And I hate to be that doomsdayer, but, like you kind of feel like it is guided in a sense to be like, hey, Jose, take on this debt. Don't worry. And it's just like we're waiting for you to crumble so we can come be hey, you know what? I'll take it off your shoulders. Don't worry. I'll give you $100,000 less than you paid for it, and you won't have another option, so you're going to take it.
And to that extent, Rohi, I agree that sometimes certain economic policies and or events do have casualties. And obviously we saw it in 2008. Yeah. It builds up over the years. A lot of times it's not as publicized as we want to see, but if you look at the foreclosure rates, if you look at your delinquencies or your defaults, they're starting to creep up.
Yeah.
Now, they haven't gone into the market for trustee sales, but there's notices. And they're recorded. They're recorded. It's public information. So I think it gets scary when it starts jumping out to a point where it's beyond what we perceive as what's normal for foreclosures, right? You have so many homes, so there's going to be so many foreclosures. But one of the things that I try to track is I look at, are these foreclosures or pre-foreclosures, are they recorded? If you're trying to modify, how many of those are in that process of saying, you know what, I've called my bank, I've had a hard time, because the bank will start recording that when you get to a certain point. It may not be the 30, maybe 60, maybe 90 days, but at that point, have you worked with your bank? And even after working with your bank, are you still finding it difficult to continue? How many of those are not disclosed out as foreclosures, right?
Yeah.
So there could be an underlying data point that we don't know, but we do know that foreclosures are evident, and they're happening. They happen. People run into financial issues. I think I was talking to you. Major companies are starting to slash, certain employment because they no longer can sustain. Right? They're looking at the viability of their company, so they're saying we're going to take down this amount or this section of employees in these areas that are not performing, right?
Yeah.
And you see that with a lot of these big mortar and brick stores that people are closing. Stores are closing. What's funny is that I saw a video. I go through TikTok here and there, and I saw a video, and they always put these songs that are very they bring back memories of when Sears was there, Mervyn's, Toys R Us, wow, I didn't even know they were still in business, but they brought them there because maybe back east they have these companies, whether it's a food chain or some retail. But it's sad to see, and the music that they put behind it is like, oh man, I remember that.
Yeah.
That used to be such a great store to go to.
Yeah.
It's no longer there, right? And then it keeps on showing you these pictures of all these stores that are either have ran out of business or are closing their stores, and a big portion of them.
Yeah.
And it's sad because growing up, when we used to go to the mall, we would jump into a lot of these different stores, right? We'd go to Sears, we'd have something at Sparrow's, then we'd go down to JCPenney, we'd go down to Mervyn's, and as I'm mentioning these, a couple of them are not there anymore, right? Or at least in the malls that I grew up in.
Yeah.
And that's happening nationwide because the way we shop now has changed and it's morphed, and you see a lot more boxes coming to your house now. That seems to be the future, especially we're not out there socializing in these malls anymore. We're not buying stuff. We're buying them online.
And a lot of that just, again, it's just the cost of doing business has gotten so out of hand. I mean, that's where, I think the experience of you're talking about the Toys R Us. Like when you said Toys R Us, the experience of, obviously your kids, so everything looks gigantic compared to probably what it actually was. But, seeing a gigantic warehouse full of toys that I can touch and feel and look at, and oh my gosh, that experience you can't do online. You can only look at so much picture online. You can't touch that item online. So I think there's a need for that kind of place, but the ability to do business, to have that building, to pay that rent, to pay the 40, 50 employees it takes to keep it stocked and cleaned and, checking out, it just can't sustain itself. So, again, maybe it means that robot revolution has to happen so that there is no real people working the place, or some of these new idea like the grocery stores where there's no humans. It's just, automatic checkouts and whatever. But I think as humans, we still crave that going out, and again, whether it's being together, the community part, the touchy-feely part, there's still a need for that. It just, these corporations, when they look at the bottom dollar, it doesn't make financial sense.
Yeah. No, and I mean, like anything else, Rohi, and I think this is where you and I think we agree on a lot of these things, is how we see these private corporate companies take measures to try to cut expenses, right?
Yeah.
You and I at home would probably do that, or any person that knows that, hey, I'm not bringing in this much income, and my expenses are exceeding that income, and therefore I need to cut back. How many of us really do that,
Yeah.
right? And I can't put quantify a percentage, but I can tell you based on what I see, what comes through me, I can see that a good portion of people sometimes are a little over leveraged, and not all. I mean, there's responsible people, but then we see this kind of leak on to a lot of government, right? And we hear about governments or public agencies that may be failing, or maybe in a deficit, whether it's your neighbors on the south, your neighbors to the north, but there's always this thing about budget. Like, I mean, you understand that you can't just say I'm going to slash all this department, and not expect consequences in areas that department serves, right? So that's the hardest thing about, I think, in the private sector versus public agency, and that's the fight that we have coming in from a private industry into sitting in a seat where we have to see a lot of the spending. Obviously, you want to spend it in services that you provide for your community, but at what cost, right? At what cost? And sometimes this is what we fight with all the time. Sitting on that seat is not easy because you come in with this idea that I'm going to slash spending. But once you get to it and you look at it and go, well, you can only do this much. You can only try to take care of this. It would be better to prioritize your budget by knowing where do you want to allocate most of your money. And this is something that I've always tried to champion is maybe a zero, they call it a priority budget where zero base, you start off at zero, looking at your priorities of what our community needs and start allocating monies to that, right? Because you can't take care of everything. You can't, because infrastructure is dilapidating, and if you focus all of your funding in one area, we talked about it with the CPI index, was it the conditional pavement index, right? We talked about that, and they made it sense. If you have really poor roads, it would cost you this much for every square yard or something, right?
Yeah.
Whereas if you take care of them and just maintain them, it'll cost you less. And that's no different when it comes to public agencies.
Well, I like, I guess, coming on, if you were to try to put the personal aspect to the, to what the public sector is also, but I mean, I like the idea of having the different envelopes in the sense of saying, here are the projects we want to build out, and we'll keep putting, $1,000 or whatever that number is until we can get to the amount to build it. Because again, like you say, I mean, we might want that new park, right? And it's going to cost $2 million. We don't really have the $2 million right now. We can, but then obviously now we got to take from everybody else. But if we know, hey, look, if we're budgeting $100,000 maybe every year, it's a 10-year or 20-year project, right? And maybe years get better where we can cut some of that down, but we still have a goalpost. We're still moving towards it. I think that's for me one of the things where I can agree with that mentality. It gets really difficult because that's one thing that when you started jumping into the government aspect and coming on council, where you're like, I want to get all these things done tomorrow, and and here's the money, and let's do it today. And it's like, well, no, these are like, that bridge isn't going to be built for another 10 years. You're like, 10 years? Oh my gosh, like, how can we plan for that? But you are operating in a mentality that I might not be here, but I still have to we're going to keep moving. The city's going to keep growing. These things have to be done. You just might not be here when that happens. So.
No, and well said, Rohi. I think in many cases, we don't always look at it that way, but that is a good way to think about it, and I think we should take that approach. Now, I do want to share this last screen before we wrap it up, right? And this last screen will give us some information because the topic was about housing, right? Mm-hmm. Like, and how is it that the housing market, is it good for me now, right? And I can show you metrics as far as, or data points as far as what's out there, the inventory, how long it's been out in the market. But all those things, they're factored into whether or not this would be a good buyer's market. And right now, I don't know that it is, because when we look at the, again, we talked about the median income at the 9363 37, right? And we showed that it was $78,000. Well, to be comfortable, Rohi, to be comfortable, a mortgage payment of 27, 29, your salary to afford that house should be about 110,000. So you're off about 30 grand. You're off about 30 grand, right? So that you're not as tight. You know, yes, you can afford it. Yes, you can make that payment, but where's that discretionary income?
Yeah.
And we talk about this over and over is how can we bring big retail? How can we bring big business into our city? Well, those numbers tell you a lot. I'm not the only one looking at that.
Yeah.
I can assure you that anyone that has an economic background and wants to bring business into the city, they have to look at this. They have to look at this is something that's, you know, economics 101. Am I going to put my business where I'm putting it there to succeed, or am I going to put it there to fail? And I'm not saying that this area isn't a successful area, because people are still resilient and they can still, but how much of that discretionary income can they use to purchase your higher end goods, right? Your restaurants that have a higher ticket price for that same sirloin that you would get at Denny's. Hey, I'm going to pay another $80 just to feel like I can do it, right?
Yeah.
Probably comes from the same
Yeah.
beef packing place, right? But nevertheless, people like certain cuts,
Yeah.
right? So again, in this area, again, they're saying about 109,000, right, to make a comfortable affordability, right? In the 3638, 97,000. This was like at 63 or 65,000. So again, 30,000. Here, it's not that far off. We saw 130,000. So maybe $10,000 to $15,000. $144,000 of a household medium. That's two people working, and typically your millennials are probably there. Between both of them, they're probably there.
Yeah.
Comfortable, right? But again, I mean, you see the differences, and this is, I'm not saying it's night and day, but there is a difference to look at.
Yeah.
Data does give you that information. You can't just speculate. This is information that's there. It's available to you. If you go to the U.S. Census Bureau, or you go through Redfin, Zillow, they have all these data points. Do they elevate it? I don't know, but they're utilizing a lot of these data points to bring together this amount. And I see it. When I see people that are over leveraged at over 50% of their debt to income, then you should have a concern. Unless they're saying, well, this is just my starting job. I'm due for an increase. One of my vehicles is going to be paid off. So that's going to free up $700, $800. Great. But what about those that don't and still buy them at those ratios? They're pretty high. And I think it's comfortable to stay at no more than 35% of your total income. So what does that mean? If you make $1,000 and that's all you make a month, then your total debt to income, meaning all your total debt in comparison to your income, should not be more than $350. And that includes your mortgage payment. So again, I'm using very simple math.
Yeah.
But you look at it for every $1,000 that you earn. So if you earn $10,000, then you'll know $3,500 may be very comfortable. That's not attainable nowadays, Rohi. You have to be pushing that to 45 to 50%. And unfortunately, that's the world today. So you can't complain about why we don't have all these things when you're missing the bigger thing, right?
Yeah.
So anyways, I thought that'd be important for us to look at. But again, if you're in a situation that you're looking to buy, again, it's not necessarily a want, it's a need. Do you need to buy? And if you do, get yourself informed. Make sure you know whether or not the mortgage payment is something that you can afford. Come see us. If you're looking to buy, I'm going to put this back up again. If you're looking to buy gold or silver, my friend here certainly can facilitate that. Or if you're looking to sell it, my friend here can facilitate that. Again, we're here, the Weekly Jargon, here to provide you information based on our personal experiences. Again, a lot of this stuff is our opinion of what we see, what we read, and we pass it on to you. Do your own research. But nevertheless, Rohi will be back next week with another interesting topic. Thank you again for watching.